Welcome back. Now we are going to talk about goodwill. It should be one word. I know I put a space there, but it's one word. Okay, so what is goodwill? Goodwill is basically, it has to be purchased. It's an asset. It's a purchased asset, and it specifically happens when we buy another company and we pay more than the fair value of the assets that we receive. Now you're thinking like, what kind of bonehead would do that? This is actually really common because the fair value of the assets we receive may not take into account things like market share we're trying to get. Maybe we're buying a competitor to get them out of our way. Maybe we're buying a company that has technology that has synergies with ours, meaning the sum is greater than the whole of the parts, or the whole is greater than the sum of the parts. And so once we put their technology with our technology, it's going to make us a ton of money. So there's different reasons, but this is actually really common. When I worked at Oracle, I worked on over 100 acquisitions, and we paid an excess amount and ended up with goodwill on every single one. Okay, so if you've got your worksheet, you see that Hats Off buys Cappies for $5 million cash. The fair value of Cappies' intangible net assets is $2.5 million. There's also a copyright valued at $100,000, a patent valued at $300,000, and a customer list valued at $200,000. Okay. So we are going to calculate what would our goodwill be. You're probably wondering about this thing called tangible net assets. So tangible net assets are cash, accounts receivable, fixed assets, minus accounts payable, notes payable, long-term debt. It's basically it's all of our assets minus our liabilities. We could list them all out separately, but this would turn this video into a multi-chapter mini-series. So for the purposes of learning goodwill, we're just going to call those tangible net assets, but know that if you were doing this in real life, you would be listing out all of those assets separately. Fair enough? Okay. So to calculate goodwill, we're going to start with the purchase price. Purchase price is $5 million. And then we're going to subtract everything that we know we bought. So first is the tangible net assets. Okay, we also bought a copyright. And a patent. And a customer list. Okay, so we paid $5 million. We got tangible net assets of $2.5 million, a copyright for $100,000, a patent for $300,000, and a customer list for $200,000. That's all we got. So anything that we paid above the value of those four assets is goodwill. So if I take my $5 million and I subtract the value of the assets I bought, the tangible net assets, the copyright, the patent, and the customer list, I end up with $1.9 million. That's not accounted for, and that becomes goodwill, my asset of goodwill. Okay, let's do the journal entry. Then we're going to talk about impairment, and then that'll be it. Okay, journal entry for this purchase, if we are Hats Off, is first we're going to debit what we got. So we're going to debit tangible net assets. All right, so we're gonna debit what we got. We're gonna debit tangible net assets for 2.5 million. We're gonna debit the copyright for 100,000. We're gonna debit patent for 300,000. These are all accounts. Well, not this one, we've already talked about that, but copyright and patent are gonna be their own account. And we're gonna debit customer list for 200,000. If we don't have an account called customer list, that may just go into other intangibles. It just depends on what we've set up as an account, and that's kind of up to us as the accountants. All right, and then we're gonna credit cash for the amount we paid, the 5 million. Right now our debits don't equal our credit, so to make a match, we are going to debit goodwill, our intangible asset of goodwill, for $1.9 million. Okay, and that's our journal entry to record, and we do this at the time that we acquire a company. So we acquire a company, we pay the 5 million bucks, we get all of these assets, and that's when we record goodwill. All right, let me erase the board, and then we're going to talk about impairment. In fact, you know what? Let's